Hello everyone, and thanks for tuning in to the Mutual Fund Show. It's Wednesday, it's 12:30, your appointment with us out here at Bloomberg Quint, wherein we try and tell you all that we possibly can about mutual funds, how you should invest, how you should construct a portfolio, what are the pitfalls that you should be watching out for, themes that you should be watching out for, and lots more. Today it's a very special set of guests that we have. The latest campaign of the house is Think Equity, Think Motilal Oswal. They pride themselves on being experts of the equity markets, and their funds are probably positioned accordingly. We'll talk about those funds and what's the merit of investing in equity funds from here on while the markets are sitting pretty at new highs. Also on the show a bit later on the Mutual Fund Show, we'll have an advisor coming in and talking about what is it or how is it that you can buy into funds other than the Motilal Oswal funds as well. A lot of you would have questions, so feel free to write in your questions. We have a few questions already, we'll try and answer them and lots more. But first, on the Mutual Fund Show, let's get in our guests for today. Need no introduction, the think tank, the men who manage Motilal Oswal AMC. Gentlemen, thank you so much for joining in.
Thank you. Thanks for having us.
And taking the time out and joining us on the Mutual Fund Show. It's a special thing. We've started this about 9 or 10 weeks ago. And the message that we are trying to take to customers is that if you do not know how to invest in equity markets, do it to the mutual fund route. So thank you so much for joining in. Let me start off with you, Ashish. The question that probably comes in to almost every investor's mind is that while mutual funds are the right vehicle to invest, is this a good time to invest in mutual funds?
So that's the holy grail of investing, in terms of when is it a right time to really invest.
Right.
And on a lighter note, I meet a lot of investors, and sometimes I find it funny because if the market is 9600, investors tell me that we'll wait for it to come down. And by chance, if 9600 becomes 8600, then they tell me I'll wait till it becomes 7600. So it's never a good time. I say something cliched, the whole point is that whether it's the GDP or whether it is corporate earnings or whether it's the market, at regular intervals and perpetually they make new highs. So, any time is a good time as long as you have the right time horizon. Actually, that is more important than the entry point.
And by right time horizon, I presume you're saying that people should have a long-term view in mind when they are investing in mutual funds.
Yeah,
whenever they are investing.
Yeah, absolutely. Because whether it's portfolio managers or some big guru, whoever you talk to, none of us actually predicts or none of us can control the share price or the NAV. See, at Motilal Oswal, we are very clear that what we are controlling is the kind of companies we buy and what is our understanding of their earnings power, right? So we can work towards a portfolio where earnings double in 3 to 4 years, but share prices could lead or lag. There's no control on that.
That's true.
So as long as investors stay put with us, they are bound to make good returns, but that staying put is the key part.
Okay. Gautam, thanks for taking time and joining us as well. Now, the question again, and I think it's a similar vein to what I was asking Ashish. You manage these funds which have done remarkably well. Do people question you? Because I think a few questions have come to us that way, that if your show recommended a fund, the NAV of this fund was X last year, now it is X plus Y, maybe the fund is expensive. Is that the right way to approach investing in a mutual fund?
No, not at all. In fact, when you are coming in at any possible NAV, right? The NAV doesn't connect anything about expensive. It could be cheap, it could be. It all depends on the future earnings growth that this fund will deliver from the portfolio of stocks that it holds from here till, let's say, the next 3-5 years. The important thing to remember, and building on Ashish's point, that you have to remember as an investor that equity is a long-term asset class. Multiple studies have proven that in the long term, equity gives the returns that the investor deserves in terms of the stock selection that we have done, right? So if you build a portfolio which is compounding earnings at 20%, and you stay invested for 10 years, chances are that your returns will be very close to 20%, irrespective of when you start. In fact, the expensiveness bit is more dependent on where the market is. Yes, the market is expensive today. No one denies that. But think about it. Over a 10-year period, even if the market is today expensive and when you are exiting after 10 years it corrects, how much can the P of the market correct? The P is not a very volatile number.
Sure.
It can correct by 20% maybe, which spread over 10 years is 2% compounded. But your earnings can compound at 20%. So that is the game. So the equity as an asset class has to be played with the long term in mind. many people in India are habituated to playing real estate that way, investing in real estate. Anyways, real estate has been the most popular investment class for Indians, middle class Indians, mostly because of tax reasons, sadly so, yes. But let's not debate that. But what I'm trying to infer, the happy side is that habit of investing for the long term is already there. Most people don't invest in real estate to flip in next 3 months or 6 months or expecting a very high return.
So they should have that approach for equities as well.
Just bring that habit to equities, to mutual funds, stay put. Ideally, I would suggest that go for a locked in fund, so that you are disciplined or forced not to exit.
Okay, are you guys bullish on the markets right now?
We are perennially bullish in the markets in a sense, but the caveat is, we are long-term investors, right?
Sure.
So we are perennial investors in Indian equities. So for us, Nifty moving 20% higher than average, that is not sufficient enough to make us bearish. But yes, of course, we can see that there is a volatility aspect to markets, very important. While markets do mirror earnings growth over the long term, but volatility plays a major role in the short term.
Got it.
Last 3 years, we have seen the volatility favor us. So coming 1 year, can the volatility be against us? Chances are it could be.
Yes.
We cannot predict that. So for near-term investors or people who are coming from a 1 year perspective, there is a risk of a correction. But stay put, stay invested for at least 5 years and you will reap the benefits.
Okay, just before we talk about a specific fund, I'll get in Jayesh Khilnani from our research desk to talk about that. But Ashish, the conversations that we've had, picking up a mutual fund would be akin to picking up a right stock as well, right? I mean, don't go out and just bet on a fund because you've seen the past performance. Try and either figure out the fund manager's strategy or have a financial advisor. That would be a preferred way to do it. What do you think?
So, my fear about, there are a lot of people who are now finding mutual fund as a mainstream investment.
Right.
And my fear with investors is that I think 99.9% of them, they don't realize that the performance is an outcome. And whether it is life or investing or whatever, you don't get the outcome by chasing the outcome.
Right.
To get the outcome, what you need to chase is the consistency and quality of the inputs.
Sure.
Right. So if you find the best chef in the country, he ensures the consistency by ensuring the consistency of the raw materials, the temperature it is cooked at, and the equipment which is used and where the raw material is sourced from.
Yeah.
So in your question, the same thing applies to mutual funds because everybody decides we are good or bad only based on the outcome.
Right.
They need to decide whether it's good or bad based on the consistency and quality of inputs, which is what is important. So, I think most people don't realize this, and to that extent, definitely, they need to take help from a financial advisor or whoever can actually guide them. And even if they insist on doing it on themselves, then they should definitely look for the process and not just get carried away by the outcomes.
Got it.
And last bit, I'm not saying you should not look at the outcome or performance. The outcome or performance is good to just get into the door.
Right.
But then you are concerned with the sustainability, and sustainability will come only if you understand the input or the process itself.
Okay, important points to consider. We already have a few people who are tuning in and asking questions as well. There is Kamlesh Patel or Kamesh Patel asking about an index fund. Mr. Satyavat Mishra talking about the most mid-cap 30 performance, and we'll talk about all of that. But before that, I think one fund that has really done wonders, not just for the Motilal Oswal house, but for people investing across multi-cap funds, is the Motilal Oswal Multi-Cap 35 fund. And Jayesh Khilnani wanted to bring out the finer aspects of this fund. Where is it that it has invested and what the performance has been over the past 2 or 3 years. Jayesh, over to you.
Thank you very much for that, Niraj. Well, today I want to highlight some of the key facts of the Motilal Oswal Focused Multi-Cap 35 Fund. As the name suggests, they invest into a maximum of 35 stocks with a minimum allocation of about 65% into equities. In the last 3 years, their assets under management have grown from 250 crores to nearly 7,000 crores today. Let's have a look at their sector allocation and their top stock holdings. Well, over 40% has been allocated to the financial space, with HDFC Bank and IndusInd Bank featuring in the top 5 holdings. Now, the top 5 holdings contribute nearly 40% to their NAV, and the top 10 stocks contribute nearly 70% to their NAV. So, how has been the performance of the fund? Well, over the last 3 years, the fund has significantly outperformed the benchmark index. A lump sum investor would have nearly doubled his money in the last 3 years. Back to you.
Okay, thanks for that, Jayesh. The man who manages the fund is here with us as well. So it's been a special performance by Multicap 35. What's gone into it? I mean, I'm sure a lot of funds do well, and probably different funds have different reasons. Why is it that this one does what it does? Aside of having a great fund manager, of course.
I think it is, so if I try to break down the formula of performance, right, attribution, the way we look at it, everybody looks at it actually. It's stock selection and allocation. Whether you have selected the right stocks, firstly, and secondly, whether you have allocated enough into the right stocks. Thankfully for us, and I'm especially happy that when I look at the last 3 years and look at the large cap stocks which have done really well, be it the SGFC brothers, Maruti, Eicher, in the Saint Bank, HP, BP, which are large caps now, we have been there in all of them with remarkable allocations to both selection, especially in large caps, I would say, because in mid caps, a lot of stocks have really done well. So I cannot say that we have just picked the right ones and others have not. And mid cap allocation has always been lower than large cap allocation in this fund. On an average, I think large cap would have been more like 70%. Mid cap would have been more 30%. Mind you, this is in a market where mid caps have been flying,
right.
Mid caps have been rallying.
Sure.
So I think our large cap selection has been very good, and that gives me a lot more confidence because as a fund manager, you know that large caps are way more competitive than mid caps, and succeeding in large caps really proves your true merit as a fund manager and your capacity to take more money.
Right.
Because those are the liquid stocks. Those are stocks which can absorb large corpuses. So I think doing well on the large cap side, having select very good mid caps like Ajanta Pharma, a Gujarat Power in the past, which have really done well. HP went from being a mid cap to large cap in the last 3 years. So mid cap side also there have been good successes which have been multi-baggers.
I'm sure.
So both sides actually, but I'm more happy about the large cap set, the selection of the large caps as well as allocation there.
Ashish, what about, what's your opinion on you guys have different funds. I know you can't choose one from the other because you manage all of them, but the performance of Multicap 35 has been especially special.
So I think obviously Gautam has addressed most
Almost
of it, but
yeah.
there are a couple of things that I am particularly proud of. See, one is that we differentiate ourselves by having a select number of stocks. So he doesn't have the luxury to buy 50, 60 or 70 or pretty much buy a large part of the market. So I think being a high conviction investor, I think he stressed a lot on the percentage allocation per stock.
Yes.
Because a lot of times what happens is that mutual fund schemes have nothing allocations.
Right.
Let us say he named some stocks which were his success stories, but the difference is whether you have 1% allocation, 6% or 9% allocation. And I find that there are a lot of funds which have 50 stocks with 2-3% average allocations. And then sometimes they just track the broader market.
Sure.
And I also meet a lot of investors who have 10 different schemes in the portfolio, so they are pretty much owning the whole market. So I think given that we've chosen to be a high conviction manager, that means the stock picks have to do very well.
So that philosophy should probably translate into the other funds as well. There is a question that has come in, as I said, from Satyavrat Mishra, and he's asking that why is it that the most mid-cap 30 performance has not been that good?
Right.
Hey, what do you want to?
So the observation is right in the sense that the last 1 year particularly, so if you ask me, I'm very proud of the performance from a 3-year perspective. That fund had inception somewhere in February of 2014. So we're just about 3 years and 3 months now.
Yeah. How large is the fund?
It's about 1400 crores in size.
Okay.
So the first 2.5 years were fabulous. And it has hit a kind of a lean spot in the last 6 to 9 months. And to be honest, in the last 6 to 9 months, it has actually done a bit less than the index itself. So that's not great. It's not something that I should be proud of.
Right.
But what one needs to look at is that, the best of funds, they go through certain, like if you see right now, if you take the mid-cap universe, the 1 year return will look like some 30% and stuff. So on its own, it would have done very, very well. With respect to the index, it has underperformed a bit. And if you see the whole universe, you will find it quite funny that most mid-cap funds have underperformed the index in the last 1 year. That is also because if you see in the last 1 year, there has been a sudden bump up.
Right.
See, 2 years back, a year back, if we didn't have any commodity exposure, if we did not have any risk interest rate sensitives, if we did not have banks riddled with NPAs,
right,
you were doing very, very well. So high quality portfolio in mid-cap did very, very well. In fact, since inception, the NAV is more than doubled. So 10 rupees has become more like 24, 25. But the lean patch has come in the last 6 to 9 months because some of our top holdings, we don't buy commodities. We don't buy deep cyclicals which will suddenly just give you a high beta rally. So his observation is right, but I think one needs to look at a slightly longer term perspective. And I accept that last 6 to 9 months not been great. I think it's a matter of time. Ultimately we are following, like you said, the same philosophy, same process across the funds.
Your funds.
And the earnings growth in the portfolio will be in excess of 20%, but share prices sometimes, they can lead and lag.
Okay. Now you guys think equity, right? Your latest, it's a fabulous ad. I must compliment you guys. It's a fabulous ad from the house of Motilal Oswal. That whole focus bit that you're getting in. But Gautam, my question to you is this: the last 8 episodes that we've done, we've gotten a couple of fund managers from different houses who thought that at the current juncture, investing in balanced funds was a better idea than investing in pure play equity funds. Now you guys think equity. Do you differ from this view? And if so, why? If no, then why not?
Sure, that's a question that even I ask myself, very often nowadays. And I can see the reason why people would choose balanced funds today. That's because market looks expensive. As I said, the volatility we have seen, only the upside of volatility last 3 years.
Sure.
Good chances that market was correct. But one thing is the market, the other thing is the fund. So if you really believe that equity is the best asset class to address your wealth creation needs, and if you are a patient investor who has at least a 3 to 5 year horizon, ideally 5 years, bare minimum 3 years, come into equities even today. Come into pure equities even today. If your horizon is only 1 year and you don't want to miss the upside completely, but you still are not sure that you want to do 100% equity because your horizon is short or you don't have the risk appetite, then yes, Dynamic is a product for that. And mind you, there's a enormous amount of money which has that kind of risk appetite or that kind of tenure, right, in mind. So there is a good, I would say, asset liability match, right, Ashish, in that sense that there is a lot of people who have that tenure and risk in their mind, and you have a product which matches that. So it's a product for certain kind of people. So it's for us as a equity investor, I would still suggest go for equities, go for the long.
My issue with our industry sometimes is that pardon me using a bit of Hindi here. Sometimes certain things get positioned as if it's a Ramband ilaj, कि हर बरस की यही दवा है.
Okay.
So I think when something gets a generic, when a product becomes a generic, then I start getting a little worried about it, honestly. And that's what I think Gautam is also highlighting, that it's not something that everybody has to just go into one particular category.
True.
We ourselves manage a dynamic fund, but clearly when in equities you try to reduce the volatility, then you be clear that on the upside also you'll cut off some of the return. I think that people should be clear about.
Yeah. So, well, viewers, couple of things here, and I think I'm basing it on the questions that I'm getting. There are some questions for a DSP BlackRock fund, for example, or an index fund, and that's something that a guest who comes later on will talk about that, because I can't ask these gentlemen to recommend some other funds or probably even recommend their own funds. So that is one thing that I need to tell about. Two, I think taking up a very important cue from both our guests, and I'll ask them about that as well. But maybe one, there is no standard approach to investing in mutual funds as well. The time horizon itself would probably lend itself to investing in different kind of funds. Maybe, as he's saying, there is no single remedy for the kind of goals that you may have. If it's a goal-based investing, you probably need to look at funds accordingly, and therefore maybe having a financial advisor who takes stock of what your goals are, what your inflows are, and therefore your outflows could be into different asset schemes would be a very, very important thing to do as well. Before I finally ask about a couple of questions and then take in questions from our guests as well, Ashish, I have a small question on one of the other funds that people have spoken about, and that is on the NASDAQ fund, the NASDAQ 100 fund. Yeah. Now, what is this about? What kind of investor should invest in this? I don't know if Gautam manages it, but this is just a broad example question.
So basically, it's like we have active funds and we have passive funds also. Right. Originally, our company started with PMS, then passive funds, and then active funds.
Right.
So we manage about 120 crores across passive funds. Now, NASDAQ is one of the best funds that we have done. We launched it somewhere in 2011, 2012. What specifically this fund does is that it's a passive fund. It tracks the NASDAQ 100 index. So meaning that Indian investors are investing in INR, in rupees, and the responsibility is on us to actually send that money to US and ensure that it replicates the Nasdaq 100 index itself.
Okay.
Right? Now, who should actually invest in this and why it has done well? One is it has done well because obviously the top holdings are, where we are on, like the Facebook or the Google or Apple or, Netflix, these kind of stocks, because that's what the Nasdaq 100 index is like a frontier index, right? It has biotech, artificial intelligence, etc. So it's done pretty well for itself. The second thing is that who should look for it is people who are looking for diversification. Because, what has happened is in India, any which way equity exposure has been less.
Right.
And all of us are Indians invested in India. Right, but the whole point is that there are other markets and other companies and other currencies which also do very, very well. Second is that for a lot of us, when we are doing our goal planning, a lot of our liabilities could be in dollars. If your kid or his kid or somebody is going to go to US to study, your liability is actually in dollars. So one is that you are investing in US oriented growth.
Right.
A lot of these US companies are actually emerging market companies because their revenue comes from emerging markets and it is a dollar-based fund.
Right.
So I think it is relevant for anybody who is doing appropriate asset allocation and goal planning. A lot of times also a lot of HNIs invest in this kind of product, purely for diversification. Because if everything is in INR and everything is in the Indian market.
So you get investors who invest large sums of money in a fund like this?
Oh yeah.
Okay.
I mean, the fund by itself is not very, very large because it's about 70 crores in corpus despite the track record. I think that is more a challenge to do with execution related to the ETFs, because sometimes on the exchange the liquidity in ETFs may not be very high. Plus, if the investor wants to create units directly with us, then they need to invest as much as 3 crores. So the choice is to buy or sell on the exchange, or if you want to deal directly with the fund, then the tranche has to be very large. So there are execution related challenges whereby ETF as a space hasn't grown that much.
Sure.
But if you ask me purely on merit, it's a great product.
Okay. So that answers part one of the question. Part two of the question was whether somebody should invest in the fund or no. Now, whether it's a great level. Now, I know I can't ask you that because it will be wrong on my part to do that. If you can, great. But there is a linked question that somebody said specifically, Niraj Shah, and is asking, please ask the gentleman from Motilal Oswal about their view on IT. Now, it's not apples and oranges, but I'm just linking it to Nasdaq and therefore IT. Do you have a thought here?
Sure. We have a lot of thoughts on IT, honestly. It is one of the most important things that occupy our minds because, in this country, $170 billion revenues come out of this industry. This is the only genuine large-scale export revenue base that we have established as a country. Very important for us. It is undergoing a major transition, the most challenging transition of its history. The base is also very high, revenue base is very high, employee count is very high, so it will be a tough transition. But we are confident that that transition to digital will be made successfully. Digital is just one word, many things are happening. Cloud is there, analytics is there, so the entire nature of engagement is changing, platformization is happening. So it's a very complex evolution, but we believe that Indian IT vendors are on top of it and they will eventually they will make that transition, but it will be some time before it starts reflecting in good growth numbers for the industry. So we'll go through a patch of low growth or no growth and then it will bounce back, maybe another couple of years. And I think related to the Nasdaq question, see the productivity gains, economic growth happens through demographics and productivity gains. The entire productivity gains that are happening in the world economy today are getting captured through these California-based, Silicon Valley-based companies, right? The names Ashish mentioned, including yours, Facebook and Google,
GAFA, whatever you call it.
Even the biotech names. So, as an investor, I think it's a good idea to have some allocation there because what will drive growth will either be productivity or demographics. For demographics, you are playing India, best demographics in the world. For productivity gains, it's a wise choice to have some allocation there. Valuations, of course, is a different question, but it's an index, so it will rebalance itself. So if you are a long-term investor, might be a good idea.
For a diversified exposure as well.
Yeah.
Last couple of questions. Ashish, a lot of people have heard these comments from various people, including Ramdev Agrawal at some point of time as well. I don't remember the exact numbers, but people talking about index levels going up to 1 lakh crore, so on and so forth. Sensex at 1 lakh, Nifty at whatever number of levels, etc. Now, I know people miss out on the basic power of compounding and therefore they don't quite get this math. But my question to you is, for people who are investing in funds right now and thinking that if I invest right now and if the market is going to go up to those levels, the kind of wealth creation, how many years do I have to wait for that? Are there timelines that you have in mind that if under an ideal scenario, because I look at the statistics, for example, your multi-cap 35, the CAGR growth rate has been phenomenal. If I'm not wrong, it's been 30% over the last 3 years, which more than doubles the money put in.
Yeah.
Now, is that kind of scope available for a mutual fund investor right now? Or do you believe that people should now brace themselves for slightly lower returns?
So,
from this point onwards.
Yeah. So at our end, our firm belief is, because we are very old-fashioned stock picking type investors. If you realize any of our communication, we don't discuss so much about macros or markets or politics. Our entire quest is that if we have 18 to 20 companies in the portfolio, then Gautam and the research team and everybody, they have a target that these 18-20 companies, they are focused on the earnings growth of the companies, right? And there is only one thing which can ensure the compounding of share prices, which is compounding of earnings growth, right? Now the whole point is that a lot of times people think about the index. We are actually index agnostic, because the index has PSU banks also, index has telecom companies also, and the index has IT companies also and pharma companies also.
Sure.
We are concerned with staying invested in a space which is growing at a certain rate.
Right.
That is one.
Right.
Second is that, you quoted the last 3-year return. Now there will be periods of time when share prices will run faster than earnings. Maybe last 2-3 years has been like that. And there will be times when share prices will kind of take a breather and let the earnings to catch up. Now, when there is headwind, when there is tailwind, nobody can predict.
Right.
The only thing which we can predict is what kind of earnings growth will come. So, I know that there's no straightforward answer to this, but I think that investors have a lot to look forward to.
Okay.
We are living in a country where the Prime Minister has to come and say, please open bank accounts. Or, you give me 300 rupees, I'll give you 2 lakh rupees of insurance. So, our penetration is pretty much next to nothing. We are at a space in time when insurance companies are getting listed for the first time in India. If you were in US and you ask someone that, I want 20% earning growth, what stocks will you buy? The guy will scratch his head and eventually tell you some of the companies in the Nasdaq itself. In India, if I tell you that, make a portfolio where companies, earnings will grow at 20%, and maybe you'll scratch your head, but you just imagine you come up with, say, something like insurance.
Yeah.
I mean, our stage of evolution is leaving a lot of scope for us.
Okay.
Right? So investors have a lot to look forward to and nothing to really. In fact, all these ups and downs and market discussions can only violate the best of futuristic plans can get distracted with too much market discussion, if you really ask me.
Okay, so we'll try and limit that to a minimum, and I think we'll get in the mutual fund advisor as well in just moments from now to talk about this. But one final question: GST, and will it play any kind of a role from an investor's perspective in terms of cost? I mean, the question that is coming is how GST plays a role on the mutual fund growth. This is from Aniket Golab, but I'm just loosely putting out GST and its impact on the mutual fund industry.
I'll let Gautam to answer the view on the sectors, but on the mutual fund side, or whatever is happening in our country, keep one thing in mind, that mutual funds and capital market investments, so GST, demonetization, low interest rates. See, my industry has been digital and cashless now for 20 years. Okay, I've spent a good part of my career competing with the government of India because they were issuing bonds at 11% tax-free and PPF rate at 12% and all. Right. So that competition is out. We are already digital and cashless, right? And anything which gives a fillip to organized industry, anything which improves macros, will always be a tailwind to capital market investments. Now, coming to sectors, maybe Gautam can take it up.
So, broader economy, I think 2-3 important aspects are there. One is this organized gaining a foothold where unorganized has been strong across sectors, gradual but should happen. Second is, of course, digitalization of the economy, which we have seen post-demon also. As more and more enterprises, individuals to come within the entire data framework of the government, taxation-led or whatever, because of GST and because of the government initiatives, that means that the penetration of banking in this country, which is absolutely low, will continue to go down the pyramid, right? So the classic belief had been that only top 20% of the Indian population is bankable. That number will improve over a period of time. So I think that's another important aspect that needs to be kept in mind over a long period of time, and that would hold for SMEs, unorganized SMEs becoming organized, a lot of data getting collected where there was none earlier. The third, of course, will be the productivity gains on the logistics side. Right, that itself should give some spurt to the economy, because that entire problem of trucks waiting for 2-3 days at borders and all, that will come down eventually. So that will also help economic growth. So I think these are the three main aspects that we are looking forward to. I don't think that looking for just a pure GST play is such a great idea, because investing in stocks is a holistic exercise, right? Yeah. So you do have to see what impact it has on your holdings or stock that you are evaluating. But I think largely banks, smaller banks, I would be very excited about, especially the ones who have capabilities to work with SMEs and lower down the pyramid.
Well, your answers are like your investment approach, bottoms up, and that's what you guys do best. But great performance, guys, on a bunch of these funds. Thank you so much for joining me today on the Mutual Fund Show, talking about your funds, but talking about the broader investment philosophy into funds as well. It's been a pleasure having you.
Thank you.
We look forward to have you more often on this forum as well.
Sure.
Thank you.
Okay.
Look forward to your launch.
Yeah, thank you so much. I'll be looking forward to that as well. So that's the think tank of Motilal Oswal AMC, talking about their thoughts on how you could approach investing in mutual funds. Clearly, I think the one takeaway for me was a question that I asked Ashish Somaya, and he responded very well, saying that investors have a lot to look forward to over the course of the next 3, 5, 10 years. We are a growing economy, and if you invest systematically into whichever asset class, but particularly equity-linked funds as well, the scope of growth could be fairly high. Now, a lot of questions have come in about specific funds, whether Kamesh Patel is asking about suggesting an index fund. There is Pankaj Srivastav talking about how is DSP's fund and which fund is best for long term. So a bunch of these things, bunch of questions like these. There's also some stock specific questions, unfortunately, which I can't answer. But let's get in Vishal Doshi. He has a set of recommendations, of course, but let's first ask him about a few questions that we've gotten in. Vishal, thanks for taking the time out. Sure, thanks for waiting by patiently while we were talking to a couple of fund managers. A few questions that have come out, Vishal, and one of them is asking for a suggestion on the index fund. I mean, which would be a better index fund for investors to consider right now, and why?
Niraj, there are many index funds, as you may very well know. Now, for a country like India, which is still growing, and where probably 80% or 80 crores people are still below the age of 35, companies still have a lot of scope to beat index. So I would actually suggest investors to actually look for funds which are actively managed. However, if investors want to go for index funds, then I think Birla has a very good index fund which follows the Nifty, and investors can look at it.
Okay, that's a safe option for an index fund.
Absolutely.
The Birla fund.
Yes.
You also have a Birla fund recommendation, which is the Birla Sun Life Frontline Equity Fund. Now, why is it that you're recommending this fund? What kind of investors can buy into this fund?
Niraj, Birla Sun Life Frontline Equity Fund has almost a 15-year track record, which makes it one of the oldest funds in the industry. And it is managed by a very good fund manager, Mr. Mahesh Patil. Now, this fund is largely a large cap oriented fund. So, despite having a very large AUM of almost 17,000 crores, this fund has managed to beat the index on various time frames, which makes it one of the best large cap funds in the industry.
Okay. So that's one recommendation. Pankaj Srivastav is asking, how is DSP's fund? Now, he's not mentioned a name, but I'm presuming, I mean, the microcap fund is out of investing purposes any which ways.
Yes.
Any other DSP fund that you've analyzed, and would you be comfortable talking about or recommending?
Sure. DSP Small and Midcap Fund is a very good fund.
It's open for subscription, right?
It is open for subscription, and investors should look at this fund, which is basically investing in mid-cap companies.
Okay.
And it has done very well, and it is managed by Vinit Sambre, who is the same fund manager as the DSP Microcap Fund.
Okay.
So that makes it a good
But your recommendation is for a Reliance Small Cap Fund. Are you choosing this over the DSP Small Cap Fund, Mid-Cap Small Cap Fund?
I would prefer the Reliance Small Cap Fund.
Okay.
Simply
Why
because
would this be?
Yes. So Reliance Small Cap Fund is actually a fund which is investing in smaller stocks, which generally tend to outperform the larger peers, especially when the economy picks speed. So India at this point in time is at a stage where the economy is looking to gain speed, and smaller companies tend to outperform the larger ones. So Reliance Small Cap has got a very good track record. It has almost given a 30% CAGR return over the last 5 years.
Sure.
Making it one of the most successful schemes in the industry.
Okay. One last recommendation from your end is the L&T India Value Fund.
Yes.
Why this fund? What kind of investor should buy into this fund?
Niraj, this is a very interesting fund simply because it seeks to look into stocks which are undervalued. So basically when I say...
A lot of stocks would do that. A lot of funds would do that.
Absolutely.
So why this one?
Yeah, this one is basically because it is looking at stocks where the value of the company is much higher than the stock price. So this is offering a margin of safety to investors. So it is like they are picking value stocks. which is one of the theses of many great investors. So, and this fund has done very well over the last 5 years.
Okay. One last question. We had the House of Motilal Oswal here. Any fund from their stable which would be a worthy recommendation, because their Motilal multicap 35 fund has done well,
Yes.
but sadly for them that midcap 30 fund has not quite lived up to the mark. So,
Right.
What's happening here? Is there a fund that you would recommend from their stable?
I would prefer the multicap 35. I think that fund has done
But it's
very
gone
well.
up quite a bit already.
Yes, it has gone up quite a bit, but I think there is still scope given where the market is right now. Multi-cap funds are best suited for investors, because let the fund manager decide whether they want to invest whether in large caps, small caps, mid caps, given that the market is at a very high level. So I would prefer the multi-cap 35.
Okay, any of your existing recommendations, which is the Sun Life Frontline or the L&T India Value Fund or Reliance Small Cap Fund, would they mimic the nature of a multi-cap fund?
Not exactly, but the value fund, the L&T India Value Fund has a
Flexi cap recommendation.
It's a flexi cap, so it has the mandate to move beyond between large caps and mid caps.
Great. Vishal, thank you so much for taking the time out and joining us on the Mutual Fund Show. Really appreciate you being with us today.
Thanks,
and
Niraj.
giving us your recommendations as well.
Sure, thanks.
Well, that's it, viewers, on this leg of the Mutual Fund Show. Join in every Wednesday at 12:30 p.m. where we talk to a set of fund managers and get you a mutual fund advisor to talk about what are the funds that you could be looking to invest in as well. Remember, this week we've spoken about why is it that you should think about equity linked funds. Next week we try and speak about what are the pitfalls that could come along the way of investing, what are the downsides that you as an investor should be prepared for while taking an investment approach in mutual funds. Thanks so much for tuning in today.